Hey everyone, welcome. Today, we're doing a bit of a financial autopsy in this explainer. We're going to objectively dissect one of the absolutely most talked about segments in the whole market, and that's mid-cap funds. We're cutting through the marketing brochures and going straight into the raw data, the actual performance, and of course, the underlying risks. And to do this right, we've got a seriously fascinating institutional case study to look at. So why this specific case study? Well, 1 lakh crore rupees. Yep, you heard that right. That is the literally massive assets under management, or AUM, milestone that the HDFC Mid-Cap Opportunities Fund just crossed as it enters its 20th year. I mean, hitting a milestone of that magnitude, that doesn't just happen by accident. It represents nearly 2 decades of super disciplined investing through some wildly changing market conditions, which gives us an incredibly rich, real-world dataset to dig into. Here's our roadmap for today. We're covering decoding midcaps, historical performance, comparing peers, navigating volatility, assessing risk metrics, and finally, long-term growth for beginners. Let's jump right in. All right, Section 1, decoding midcap mutual funds. Okay, let's translate some of this financial jargon right off the bat. According to SEBI's classification here in India, a mid-cap company is a business that ranks exactly between the 101st and 250th largest companies by market cap. Honestly, think of them as the teenagers of the corporate world. They've outgrown that super volatile early startup or small cap phase, so they have proven business models. But, and this is key, they still have massive room to grow compared to those giant, mature, large cap companies. To really grasp the risk, though, we have to understand the broader market distribution. Large caps are your top 100 giants, valued above 105,000 crore rupees. Small caps? That's a huge, kind of chaotic universe of over 2,300 companies below 34,000 crore. But right there in the middle, we have this tight, concentrated group of just 150 mid-cap companies. For a conservative investor, the big takeaway here is that while this is absolutely a sweet spot for growth, this whole segment actually only makes up about 20% of the total market cap. Now, within this 150 company universe, the HDFC Mid-Cap Fund has carved out a really distinct advantage. Their whole strategy is built on bottom-up portfolio construction, basically hunting for high-quality companies at reasonable valuations. Managed by Chirag Setalvad since 2007, the fund's real secret sauce is its aggressive risk management. They diversify very carefully to cushion against the volatility that's just naturally baked into the mid-cap segment. Moving on to Section 2, historical performance and highlights. So what's the actual result of that long-term approach? A 17.16% compound annual growth rate, or CAGR, since the fund launched back in June 2007? Just think about that for a second. When you're looking at wealth creation over a 15-plus year horizon, a timeline that, by the way, includes the 2008 global financial crisis and the 2020 pandemic, maintaining a CAGR over 17% is just a phenomenal demonstration of the compounding engine that midcaps can be. But actually, let's keep it objective. We have to contrast this against the broader market benchmark, the Nifty Mid-Cap 150 TRI. Over a recent one-year period, the fund returned 4.43%, which actually trailed the benchmark's 5.79%. But if we zoom out to the 3-year and 5-year horizons, the fund delivers super strong numbers at 19.81% and 19.89%, easily beating the 5-year benchmark return of 18.37%. It's a classic example of a fund that might occasionally lag in a short sprint, but builds serious, dominant momentum over the marathon. Section 3, comparing peers and benchmarks. Now, what's really interesting is when we contrast current returns against major peer funds. You can clearly see entirely different investment philosophies at play here. Momentum-driven peers like Invesco India and Nippon India Growth have captured slightly higher short-term returns, with Invesco showing a 3-year return of 24.84%. HDFC's approach is noticeably more conservative in its stock selection. While those aggressive funds grab higher trailing CAGRs in a booming market, we have to remember that outperformance always comes with a specific trade-off. Which brings us to Section 4, navigating recent market volatility. The crucial question is, how does a fund handle the inevitable bumps in the road? Well, this is exactly where the HDFC Mid-Cap Fund flexes its defensive muscles through what we call capture ratios. The fund has an upside capture ratio of 114.1. Simply put, if the mid-cap index goes up 10%, this fund on average goes up 11.4%. But check out the downside capture ratio, 82.2. When the market drops 10%, the fund historically falls only 8.2%. It grabs more of the gains and absorbs fewer of the losses. That is strong downside protection in action. Even with that protection, we need to be absolutely clear. Mid-cap funds are universally classified as very high risk by SEBI. And why is that? First, mid-cap companies are super sensitive to economic downturns. They feel the squeeze on earnings much harder during macro slowdowns than large caps do. Second, you're just going to see greater price volatility, period. And third, unlike just passively buying a large cap index, succeeding in mid-caps is heavily reliant on active fund manager skill to find those mispriced, undiscovered gems before everyone else catches on. Section 5. Assessing key risk metrics. Let's demystify some of these risk metrics, starting with standard deviation. In mutual funds, standard deviation is basically just a statistical way to measure how wildly a fund's returns swing up and down away from its average. Honestly, just think of it as the bumpiness of the ride. A high number, that means wild, aggressive, stomach-turning swings. A lower number means the fund's performance is a much smoother, steadier experience for you, the investor. So when we actually crunch the data, the HDFC Mid-Cap Fund boasts a standard deviation of 13.84%. Compare that to the mid-cap category average, which sits noticeably higher at 15.50%. This metric directly proves what we were talking about earlier with the fund's conservative, quality-focused stock selection. Historically, it just offers a significantly smoother ride than your average mid-cap fund. Next up is beta. So what exactly is beta? It simply measures a fund's sensitivity to broader market movements. The market index itself is always assigned a baseline beta of exactly 1. If a fund has a beta higher than 1, it's more volatile, more reactive than the market. But if it has a beta lower than 1, that means the fund is theoretically less volatile than the broader market. The HDFC Mid-Cap Fund rocks a beta of 0.85. Because it's under 1, it mathematically proves the fund is significantly less sensitive to sudden market shocks. When you combine that with its positive alpha, which is just a fancy way of measuring the manager's ability to generate excess returns, a beta of 0.85 shows that this manager is delivering fantastic wealth creation while actively taking on less risk than the broader market index. Now that is a win-win. And finally, Section 6, long-term growth for beginners. Look, the absolute best way for beginners to harness a mid-cap fund is through a systematic investment plan, or SIP. Let me put this into perspective. Over a 15-year period, if you invested 10,000 rupees a month, your total out-of-pocket investment would be 18 lakh rupees. But thanks to the staggering power of compounding and this fund's 19.11% SIP return over that time, that investment grew to over 88 lakh rupees. By investing fixed amounts every single month, you naturally buy more units when the market takes a dip. It completely smooths out your entry points and makes that inherent mid-cap volatility totally bearable. So if you're a beginner looking to capture this kind of growth, here is your super simple, actionable 3-step game plan. Step 1, assess your risk tolerance. You have to know and accept that mid-caps will drop during economic slowdowns. Step 2, commit to a 7 to 10-year time horizon. Honestly, mid-caps are not for short-term trading. And Step 3, utilize monthly SIPs to manage the volatility, rather than trying to time the market by dumping in a lump sum. We've unpacked the massive scale, the historical CAGRs, the pure comparisons, and, maybe most importantly, the risk mitigation metrics that define this space. A well-managed mid-cap fund can absolutely be a massive wealth creator, assuming you have the patience to just let it work. So looking at your own asset allocation and your timeline today, does your portfolio need a mid-cap growth engine? Thanks so much for joining me on this explainer, and keep learning.